Procter & Gamble reported fiscal Q3 2026 this morning, and the headline GAAP net income figure was $18.5 million. That is not a typo. $18 million for a $346 billion company.
But the real story is the opposite of what that headline suggests. Core EPS came in at $1.66, beating estimates by 10 cents. Revenue beat by roughly $700 million.
The gap between GAAP and core comes from a $4.97 billion one-time tax charge tied to new global minimum tax legislation. Strip that out, and the underlying business actually accelerated meaningfully versus last year.
Revenue grew 7.4% year over year to $21.235 billion. Operating cash flow hit $4 billion in a single quarter. This is a clean operational beat, dressed in an ugly accounting wrapper.
So today, we unpack why the market should look past the headline, what the 8-quarter trend really shows, and whether 21 times forward earnings is the right multiple for a dividend king with a 68-year streak.
Welcome to Charged Alpha, the podcast where we break down S&P 500 earnings one stock at a time. I'm Lana, and today we are covering the Procter & Gamble Company, ticker PG, on the New York Stock Exchange.
And I'm Hudson. This episode covers fiscal Q3 FY2026, which maps to calendar Q1 2026, the January through March window. Earnings were reported this morning, April 24th.
PG is headquartered in Cincinnati, Ohio, employs approximately 108,000 people worldwide, and is led by CEO Shailesh Jejurikar, who took the top job in 2024 after decades inside the company.
It carries a market capitalization of $346 billion, a beta of 0.4, and trades at $148.11 per share heading into this print. Let's get into the history first.
Procter & Gamble traces its roots to 1837, when William Procter, a candle maker, and James Gamble, a soap maker, were pushed by their shared father-in-law to merge their small Cincinnati workshops into one partnership.
That makes the company 187 years old this year. It survived the Civil War, supplying soap and candles to the Union Army, and emerged as one of America's first true national consumer brands.
The 20th century is when the brand portfolio we know today was built. Tide launched in 1946 and revolutionized laundry. Crest arrived in 1955 as the first fluoride toothpaste accepted by the American Dental Association.
Head & Shoulders followed in 1961, the same year Pampers reinvented the diaper category. Bounty came in 1965. Each launch defined a category and entrenched PG as the dominant shelf presence in American homes.
The Gillette acquisition in 2005 was the largest deal in the company's history and gave PG control of global wet shaving. But the portfolio became bloated, and that triggered the next major strategic shift.
In 2014, PG announced it would divest roughly 100 brands and focus on its top 65. That rationalization is what created the lean 5-segment structure we analyze today, with a much sharper margin profile.
Those 5 segments are fabric and home care at 34% of revenue, baby, feminine, and family care at 25%, beauty at 19%, health care at 13%, and grooming, rounding out the last 9%.
The business model is consumer packaged goods sold at scale through mass retailers, drugstores, and increasingly e-commerce platforms. The recipe is simple to describe and brutally hard to replicate. Pricing power on one side, productivity savings on the other.
Pricing power comes from brand superiority. PEG's internal framework grades each brand against private label and competitors on product, package, communication, retail execution, and value. The goal is to be demonstrably better on every axis.
Gross margins tell that story numerically. They peaked above 53% in 2019, compressed to roughly 50% today as commodity and freight costs inflated, and management views the path back toward 52 as a structural unlock.
The portfolio is anchored by what PG calls its billion-dollar brands. Tide alone holds the number 1 position in United States laundry detergent. Pampers, Pantene, Gillette, and Crest each clear that billion-dollar threshold globally.
Fabric and home care is the engine. At 34% of revenue, it includes Tide, Ariel, Downy, Gain, Cascade, Dawn, Febreze, and Swiffer. These are sticky daily use products with predictable replenishment cycles and strong shelf positioning.
And the capital return profile is part of the brand. The $4.26 annual dividend, paid every year and raised every year for 68 consecutive years, is one of the longest dividend growth streaks in corporate America.
Now the quarter itself. Revenue of $21.235 billion beat the consensus estimate of roughly $20.53 billion. That $700 million beat works out to growth of 7.4% year over year.
For context, the comparable quarter last year, fiscal Q3 2025, was $19.776 billion. That comparison was also flattered by easy seasonality, but the absolute dollar growth still represents a real reacceleration.
Core EPS came in at $1.66 versus the $1.56 estimate. That is a 10-cent beat, or 6.4% above expectations, with no benefit from the tax line.
GAAP net income, by contrast, was just $18.5 million for the quarter. That number is not representative of operating performance because of a $4.97 billion one-time charge from global minimum tax legislation.
That charge is a true cash and book event, but it is a pull forward of taxes, not a degradation of earnings power. Analysts and management both point investors to the core EPS line as the true read.
The cash flow statement confirms that. Operating cash flow was $4.045 billion, free cash flow was $3.026 billion, and stock-based compensation stayed disciplined at $132 million.
Operating income was $4.576 billion. Gross profit was $10.513 billion on a 49.5% gross margin. Operating margin landed at 21.6%, broadly consistent with the trailing 12-month profile.
Stepping back to the 8-quarter revenue trend, fiscal Q4 2024 was $20.532 billion, Q1 2025 jumped to $21.737, and Q2 held at $21.882 billion.
Q3 2025 then dipped to $19.776 billion, which is the seasonality print Lana mentioned. The spring quarter is consistently the lightest because of consumer destocking and timing of trade promotions.
Q4 2025 recovered to $20.889 billion, then fiscal 2026 opened with a strong $22.386 billion in Q1, followed by $22.208 in Q2.
This Q3 print of $21.235 is therefore a meaningful step up versus the year-ago Q3, even as it reflects the normal seasonal sequential decline from the Q2 holiday-adjacent peak.
On core EPS, the trend is equally constructive. From $1.30 in Q4 2024, the path moved through $1.61, $1.88, $1.54, $1.51, up to $2 exactly in Q1 2026.
Q2 2026 came in at $1.88, and this quarter prints at $1.66. That seasonal Q3 dip is consistent with revenue, and the year-over-year comparison to $1.54 in Q3 2025 shows positive momentum.
The arc shows a business growing earnings through pricing, mix, and productivity, with seasonality layered on top. The 8-quarter view is more useful than any single print for understanding the underlying compounding trajectory. Moving to the balance sheet, cash sits at $12.36 billion. Total debt is $37.026 billion, leaving net debt of $24.720 billion against $54.7 billion of equity.
Total assets stand at $128.378 billion, and goodwill alone is $41.359 billion. A reminder that decades of acquisitions like Gillette still occupy a meaningful portion of the asset base.
Capital returns this quarter were heavily tilted to the dividend. PG paid out $2.53 billion in dividends, while repurchasing $625 million of stock, for total returns above $3 billion in a single quarter.
That buyback is modest relative to the $3 billion free cash flow figure, and that is by design. The dividend takes priority. Buybacks flex around it depending on share price and acquisition pipeline.
The $4.26 annual dividend implies a payout ratio of roughly 80% on core EPS. That is high, but the 68-year growth streak is a non-negotiable commitment, and the cash flow profile supports it comfortably.
Price to book sits at 6.54 times. That elevated multiple says the market values the brand portfolio, distribution relationships, and pricing rights far above the accounting book, which is the entire investment thesis in one ratio.
Returns on equity confirm it. ROE of 30.7% on a stable, low-beta consumer business is exceptional, and it is what justifies a premium valuation despite a relatively modest organic growth rate.
Speaking of valuation, let's talk forward estimates. The forward EPS projection for fiscal 2026 is $7.04, combining the three reported quarters with a Q4 consensus estimate of $1.51.
At today's $148 share price, that implies a forward price-to-earnings multiple of roughly 21 times, which sits meaningfully below the trailing 28 times that is distorted by the Q3 GAAP tax charge.
Looking further out, fiscal 2027 is modeled at $7.21 from 13 analysts, and fiscal 2028 at $7.62 from 14, with 2029 at $8.06.
That trajectory implies mid-single-digit annual EPS growth, modestly above organic revenue growth, with the gap filled by buybacks, productivity, and gradual margin recovery as commodity costs normalize over time.
The multi-year forward EPS projection therefore underpins a roughly 7% earnings compounding case, and combined with the 2.9% dividend yield, it frames a high single-digit total return profile before any multiple expansion.
Now, peer comparison. Enterprise value to EBITDA is the cleanest cross-company multiple for consumer staples because it normalizes capital structure differences. And the spreads here are very informative about how the market scores each brand portfolio.
Among PG's rivals, Unilever trades at 13.5 times, Kimberly-Clark at 14, Kenvue at 15, PG at 16.4, Colgate at 17.5, and Coca-Cola at 21 times.
Coca-Cola sits at the top because its model is asset light. Concentrate sold to bottlers carries dramatically higher returns on capital than physical CPG manufacturing, and investors reward that with a premium multiple over staples peers.
Colgate trades above PG largely because of oral care concentration and emerging market exposure, particularly in Latin America. It is also the most direct head-to-head competitor in toothpaste and personal care globally.
Unilever's discount reflects portfolio complexity, slower margin recovery, and ongoing strategic restructuring. Kimberly-Clark and Kenvue trade at structural discounts because their categories grow more slowly and pricing power is more contested.
PG's 16.4 times therefore looks fair for its quality, scale, and dividend record, while leaving a clear path to 17 or 18 if margin recovery and volume growth converge over the next 12 to 18 months.
On analyst sentiment, 13 firms cover PG, 7 carry buy or overweight ratings, 6 are at hold or neutral, and importantly, there are 0 sell ratings on the name from any covering analyst right now.
The buy side includes JP Morgan, which upgraded PG to overweight in January, alongside Wells Fargo, Bank of America Securities, UBS, Raymond James, BNP Paribas, and Jefferies, which moved to buy in December 2025.
On the cautious side, Barclays, Piper Sandler, Deutsche Bank, RBC, and Freedom Broker hold neutral, and TD Cowen downgraded to hold in January 2026 on valuation concerns rather than fundamental issues with the business.
The average price target is $170, implying roughly 15% upside from current levels, with a range stretching from $155 on the low end to $190 on the high end.
That spread is telling. Even the most cautious analyst still sees the stock as broadly fairly valued, and the most constructive sees a path toward what would essentially be a Coca-Cola-style re-rating over time.
That sets up the bull case. Pillar 1 is volume recovery. After 2 years of price-led growth, evidence that volumes are returning to positive in core North America and Europe categories would remove the central bear concern decisively.
Pillar 2 is China. SK2 has been pressured by nationalist consumer preferences and a soft prestige beauty market. A return to growth in China beauty would deliver top-line and margin upside not currently in consensus estimates.
Pillar 3 is emerging market penetration. India, Southeast Asia, and Africa offer a long-duration organic growth engine as per capita incomes rise and households trade up from local brands to PG's global premium portfolio.
Pillar 4 is the dividend king re-rating. As interest rates normalize lower, dividend growth equities historically re-rate to higher multiples, and each turn of EV to EBITDA from 16 to 17 adds roughly $15 to $20 per share.
Pillar 5 is gross margin recovery. The path from 50% back toward 52 or 53% as commodity costs normalize creates meaningful EPS leverage without requiring any acceleration in top-line revenue at all.
Stack those 5 pillars, and you can see a scenario where the market begins to assign PG a multiple closer to Colgate or Coca-Cola as the volume recovery narrative takes hold and China stabilizes.
Together, those pillars articulate the case for compounding meaningfully above the headline growth rate. But no investment thesis is complete without the symmetric risks. Let's walk the bear case in equal detail.
Bear risk 1 is foreign exchange. Roughly 55% of revenues are international, and a sustained strong dollar can subtract $500 million or more from annual EPS with no operational fix available.
Bear risk 2 is volume stagnation. If price-led growth permanently shifted some consumers to private label, organic volume could stall below 2%, removing PG's primary lever for accelerating top-line growth.
Bear risk 3 is China prolonged weakness. Nationalist consumer preference shifts could keep SK2 structurally below peak revenues for years, and the broader China softness pressures both reported growth and corporate margin mix.
Bear risk 4 is input cost reinflation. Any energy or commodity re-acceleration would compress gross margins before pricing actions can respond, directly reversing the margin recovery thesis that anchors the bull case.
Bear risk 5 is multiple compression. At 21 times forward earnings for a 4 to 5% organic grower, any rotation out of defensives could derate PG toward 18 or 19 times, costing roughly 15% in share price.
Each risk is real but manageable in isolation. The genuine danger is 2 or 3 arriving together, which would convert PG from a steady compounder into a stalled defensive trading at a contracted multiple for a sustained period.
Pulling it all together, PG at $148 trades at 21 times forward earnings for a 187-year-old business with a 68-year dividend growth streak and 30% return on equity.
It generates roughly $4 billion in quarterly operating cash flow, holds number 1 or number 2 positions across laundry, diapers, oral care, shaving, and household cleaning, and does it all with a beta of 0.4.
This quarter's GAAP headline of $18 million in net income is noise driven by a one-time global minimum tax charge. The signal is the $700 million revenue beat and the 10-cent core EPS beat against consensus.
As CEO Shailesh Jejurikar put it this morning, the Q3 results demonstrate the strength and resilience of the brand portfolio, with core EPS growth, strong operating cash flow, and continued meaningful capital return to shareholders.
For long-term investors, the question is not whether PG will compound. It almost certainly will. The question is the entry multiple, and 21 times forward looks reasonable for this quality of franchise at a 2.9% dividend yield.
For tactical investors, the setup is more nuanced. The 15% average price target upside is real but not urgent, and the volume and China data points over the next 2 quarters will dictate the near-term path.
Either way, this print reinforces why PG sits in so many core portfolios and why the 68-year dividend growth streak continues to be the most underappreciated compounding metric in the consumer staples sector.
The single most important data point to monitor in the next 2 quarters is organic volume. Revenue growth, driven by pricing alone, is fundamentally limited, and the market wants to see volume contributing alongside price at roughly a 2-to-1 ratio.
Gross margin is the second watch point. The Q3 FY2026 print of 49.5% is below the 50% TTM average, and any sequential improvement in Q4 would be an early signal that commodity cost normalization is finally feeding through.
Capital allocation is the third. The $625 million buyback this quarter is relatively light against $3 billion in free cash flow. Any acceleration of repurchases, particularly if the stock pulls back further from its highs, would amplify per-share earnings growth.
The company also guided for organic sales growth of 4 to 5% for full-year fiscal 2026 and core EPS growth in the mid to high single digits versus fiscal 2025 core EPS of $6.72.
That wraps our coverage of Procter & Gamble fiscal Q3 FY2026/calendar Q1 2026. Thanks for spending the time with us on Charged Alpha, where we break down S&P 500 earnings one stock at a time.
This podcast is for informational and entertainment purposes only and does not constitute financial advice. The information presented reflects data available at the time of recording and may not be current. Always consult a qualified financial advisor before making any investment decisions. Charged Alpha and its hosts may hold positions in securities discussed. Past performance is not indicative of future results.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.